Good day everyone and welcome to today's webinar. In this session we'll be discussing the Amity BCI Equity Income Fund and why this fund is used within income solution strategies where the outcome required is income. Lourens Coetzee will be joining me from Marriott Asset Management, that is the fund manager appointed by Amity for the Amity BCI Equity Income Fund. We will be discussing various aspects such as current markets, buy and hold strategies, quality style, holdings and distributions from the Equity Income Fund, and then later in the webinar, Amity's newest addition to the team, Wiehan Dul, will look at evidence in favor of an equity income strategy that would look at aspects such as, does a buy and hold strategy work through time? Does the dividends income keep up with inflation? Does the capital grow over time? And then the return profile of such a strategy versus the JSE, all share and a CISA general equity sector. It is important for investors to get a feel what a strategy like this can do over the long term and that it will deliver on its outcomes. Lourens Coetzee, the portfolio manager for the Amity BCI Equity Income Fund from Marriott Asset Management, joins me now. Lourens, welcome.
Thanks, Ian, and really good to be here and really look forward to today.
Lourens, before we start, I think it's important that I provide some background on Marriott as a company. Marriott Investment Managers was established in 1987. They currently hold over 34.1 billion in assets under management as at the 31st of March 2022. Marriott was acquired by Old Mutual in 2005 and now forms part of the Old Mutual Investment Group as an independent boutique. This was very interesting to me. Your aim is to create financial peace of mind through more predictable investment outcomes. Now, Lourens, as you know, Amity is an outcomes-based discretionary fund manager. How does Marriott aim to create financial peace of mind through more predictable outcomes?
Thank you for that first question, and I think it's really core to who we are. It almost really speaks to the partnership we have. There's a very much, we're kind of walking the same path. For us, it's all about more predictable investment outcomes. And it means different things for different clients. Obviously, different needs are different for when one speaks to different clients. I think the market knows us as an income specialist. If you're thinking about somebody drawing an income, bringing certainty to that outcome, for us is to spend the income, leave the capital intact. That will bring more certainty to that investor's outcome. But the cornerstone of what we do is to invest in quality companies. Now, you guys have seen this before. It's our investment filter. It's on the screen for you guys to see. What we are trying to achieve is to invest in companies, that aren't startups, companies that have a track record of paying reliable dividends, companies that generally do well in difficult conditions and good conditions. You not have to worry about them. Companies that are, likely to continue to do well even in this tough environment we're in now. And if you build your portfolios around quality, for us it means there's more certainty in the outcome. A real, cornerstone of kind of what we do is if we focus on the income, and I've given you an example here. You look at the dividend track record of Clicks. If you focus on those blue bars, the dividends that come through, and you invest in investments that continue to grow over time, we know that the capital price will follow, and that's where the certainty and outcome and more predictability comes in. So big picture, it's really close to what we do. We're trying to bring more certainty, more predictability outcomes. Quality is important. Dividends is important because you can either reinvest those dividends and get compounding from them, and there's a lot of certainty in that outcome, or you can draw them, to live off that income. So I think that gives you a sense of kind of where we think we can add value and really where our partnership, originated from.
2022 has been one of the most difficult starts to a year. Could you give a quick synopsis of markets before we delve deeper into the Amity BCI Equity Income Fund?
Yeah, Ian, I think it's really the right place to start. I think a lot of clients are going to look at, what's happened to their statements, what's happened to markets, and I think it's important to kind of put it into context. You're going to see that it's really been one of the worst starts back in history. We haven't had a start like this for a very, very long time. So what's behind all of this? So let's just start there. Just to kind of look to the US. It's always the biggest market. That's where people look to see what's happening. What we've seen there is inflation breach 8.6%. Today we're going to find out what the new number is, so we're going to see what that means. But the truth is, the market is starting to price in rate hikes to try and, deal with this high inflation. Now, if you looked at inflation, what the markets felt inflation was likely to be in 2022, those blue little dots is what it is. The red dots show you what the expectation for inflation is from a global perspective in June this year. There's been a massive increase. And really what this has all come down to is the war in Ukraine and Russia, and obviously petrol and oil prices going up. And there's obviously a food shortage with grain in Ukraine. You combine that with the supply side issues in China, and inflation is a big problem. And really what we've seen is across the world, central banks are going to address this, and they're going to address this by raising interest rates, which means borrowing costs are going to increase. They want to dampen demand, which is really affecting markets. So if you look at what's happened to markets, these are just some headlines. The S&P is having its worst start to the year since 1939. Global stocks suffer worst day since June 2020. It's been tough. And if you look at it from a numbers perspective, South Africa's equity market is down about 8%. But if you think from a global perspective, Nasdaq's down 30, the S&P 500 is down 20, global bonds is down 15. Those are big numbers. And I think what the markets are grappling with is higher rates in a more difficult environment when people can't afford it. And remember, the world's over indebted. So higher rates is really going to hurt. So that's really where we're at. It's been a tough start to the year. And I think it's important for people to look at where they're at, look at their statements in context of what's happening from a global perspective. So I think it's a good place to kind of set the scene.
While you were talking, I'm thinking that it seems even through recessions, one can achieve the outcomes of an equity income strategy. And currently it provides an opportunity to buy good quality companies at discounted prices. And that excites me. And if we jump into the positioning of the Amity BCI Equity Income Fund, and the obvious question that advisors would be asking is, why has Amity launched an equity income fund? Now, from our perspective, we believe that an investor drawing an income needs to finance this income from assets locally by doing asset liability matching. Now, with this in mind, we looked at the following criteria to determine if there was an existing equity fund that we could use. We looked at equity managers that has an income as an outcome focus. Is there a fund that has a higher starting dividend yield that grows with inflation? Does the fund use local equity and property to achieve this? Use specific property exposure and not general property counters, and no offshore exposure. Now, the conclusion was that Amity could not find an existing equity fund that was aligned to this criteria, and the reason why Amity partnered with Marriott to manage such a mandate. Now, Lourens, could you explain and expand on the philosophy and strategy of the Amity BCI Equity Income Fund? And as a follow-up question, why typically a buy and hold strategy?
Yeah, I think there's a lot there, Ian, and maybe just first and foremost, I think we would agree, as you heard up front, is so this is an equity kind of strategy. We think if you are a client that wants more certainty and outcome, and you're that client that's taking money out on a monthly basis, we think if you should have growth assets. And if you can have growth assets that can help you achieve your drawing income, your drawing of income, that's a good thing. And so as we partner together, that's really what we've created for you. We've created what we would consider the highest quality South African equity or dividend paying equities and properties, in a mix, and we'll chat about that a bit later, just for that purpose. It brings more certainty and outcome, because it's quality, it's quite defensive, which is good for retired investors or investors, that's wants a little bit more conservative. It's focused to South Africa, which means you get more income from it. So there's all those benefits. So when we started this and had these discussions with you guys, if you look at the Amity BCI Equity Income Fund, what you wanted to create was a fund that produced the highest kind of income that's inflation hedged. So, if you look at the different asset classes, cash and bonds, there's no growth in income, right? So you have to use property and equities. And you know, if you look at this graph, you know, property will give you a higher yield, kind of inflation edge, maybe a little bit less than inflation if you think theoretically long term. Equities should give you more than inflation from a growth perspective, but the yield will be a bit lower. So what we've done is we've combined property and equity in a percentage that we think will give you long-term inflation-edged income growth, and we're going to talk about that. So if we look at the mandate of the portfolio is to produce a high sustainable inflation-edged income stream using SA equity and property companies. Now, the mixture is 70-odd% equities, 25-odd% property, but what is so critical is that filtering process that we have. We have to start at quality, because if you are investing in companies, you know, that are selling basic necessities, that are selling things that you and I need on a weekly, monthly basis, you know, in tough times, that's going to continue. It's going to deliver that income for you, and we've seen that in their track records, and we can show you that. But those are the companies that you have exposure to within the portfolio. And I'll read some of them off for you. First Rand Standard Bank, banking. It's not going away. We're going to have banking here. Sanlam Insurance, you know, that's here. Spar, Shoprite, Clicks, AVI, Netcare, Life Healthcare, those are all here to stay. You've got Bidcorp, Mondi, Bidvest, Pick n Pay, and then a couple of property companies. Those are the ones we really think are the best. Growthpoint Storage, Equitas, and Nepi. Now, have a look at those names. They are quality names. They are names that's going to be here 10, 20 years from now. And if you invest in those, what you can expect from them is you know, growing dividends and over time growing capital as well. As you said, we have a buy and hold. What we want to do is we want to hold quality companies. We want to buy them at reasonable prices. We want to hold them for the long term, because if you do that, what you tend to get is those blue bars that grow. You've seen these graphs from us. Many of you guys would have seen us speak about this. They grow over time because, you know, these companies are selling the same amount of stuff, maybe even a little bit more. The prices go up, and hence, you know, your earnings and dividends will increase. And then if you look at that little red line, what you'll see is it follows that blue line over time. So historically, you know, Clicks has been quite a nice growth story. They've opened up a lot of pharmacies across South Africa in their stores. They've actually, you know, taken a lot of market share away from independent pharmacies. And, you know, their growth over the last, you know, since 2008 has been about 17%, and their prices has grown around 25%. So a little bit more price growth than income growth, but that line follows one another over time. Just show you another example, AVI, blue bars and red line following it. AVI is an interesting one. They pay out special dividends. You'll see a few green bars there. And it's just one of those ones that is at the maturity stage of their business, and, you know, they'd rather pay out the dividends, and we're happy to take that from them, and our clients need that as well. So stick to quality. What you're looking at is a strategy that is you know, looking to invest in quality type portfolios, and, you know, that is where the portfolio is positioned at the moment from a philosophy point of view.
On the buy and hold strategy, when would you sell a counter?
Okay, so that's always the interesting question. So for us, it's about predictability and outcome, and we always want to try and get you the best outcome as well. It's not just hold quality at all times. We will sell a company if we think there's, you know, issues in their outlook for earnings or dividends in the years ahead. Secondly, we will sell down if we think the price is a little bit high, and we'll, you know, redistribute that to the other positions in the portfolio. And sometimes you'll replace a stock because its valuation is so expensive, and we can, you know, buy another one. So you know, our portfolios tend to not turn over too much, because you're buying stuff. You know, if we sell something, it's almost a you know that you didn't buy it for the right reason long term, or you didn't see the issue that is appearing now. So generally what you'll see is a buy and hold. What we have seen over the last few years, which I think is important, is, and it's one of the questions I think you're gonna ask today, you know, it's not all about dividend yield. You know, sometimes the higher yielding stuff, there's issues with them. And something we really think about long and hard is the sustainability in that growing earnings and dividends over time. We spend more time there, and then we look at, is the yield that we're getting appropriate? So it's about a decent price, the yield that you're getting into, but it's about the business being able to grow in the years ahead, because that's the most important long term.
So one can say that the strategy is based on a business truth that the value of a company grows over time at the rate at which its profits grow. In the same way, the value of an investment over time grows at the rate of which its dividends and distributions grow. So income growth will drive capital value growth. You agree with that summary?
Yeah, I mean, I think you've quoted us on that, to be honest, but I think that's exactly it. Ian, the truth is, just think about a simplistic business that you have. And, probably a lot of people that are listening here will be financial advisors. Now, if you could say your annuity income stream that you're getting from managing your clients' portfolios that they invested in, increased by 10% every year. What that would mean is that if somebody wanted to buy that income stream from you, it would be worth 10% more each year. And that's really what it is. That is ultimately the best form of capital growth. It's not a D-rating or a re-rating, because ultimately it's what you're going to get from capital growth is that long-term earnings growth, because that's really what true value is at the end of the day. But absolutely agree with that statement.
Clearly, quality companies are important given the challenging environment. Could you touch on 2 companies and why you believe they will do well in the years ahead?
Yeah, thank you for this question. I think, I set the scene to say it's a tough time. And, I can't stress enough how difficult the next few years are going to be. And I think, your type of companies that you're exposed to is going to be really important. And really what I mean by that is just kind of think about the higher costs that we're all experiencing now, from petrol increases, from interest rate increases. We're going to see some more coming through. It is going to be tougher, the environment we're in. You need to be in businesses that have the ability in this higher inflation environment to pass through some price increases. Because if you can't, that means your margins go down. That means your earnings you'll go backwards. Your profits will go the wrong way. And what you'll see from many of the companies in this portfolio, they are trusted. They're brands that they have. They're selling basic necessities. People aren't going to stop buying this. And they have the ability to put up prices. And because they're basic necessities, you have to buy them. So as an example, it's one of the companies in our portfolio, Shoprite. I want to show you its dividends. You can see reliable dividends. You can see 2019, 2020, we saw a bit of a dip. But I want to just speak to kind of Shoprite. We know that they sell the basics of life, right? They are also a price leader. And I think that's really important in the environment we're in. If I remember, I think it was 2020, their roadshow, they said they had 1,000 products that they were selling under 5 rand. So value is going to be important. The price, and you've seen some of these studies. If you think about how much a trolley costs at all the different places, Checkers is very affordable relative to the rest. So it's a price leader. It's completely across South Africa. It is one of those things that we know it's going to just carry on going forward. It has the ability to increase their prices. So in this environment, it's going to continue to do well from that point of view. I think it's important to point out 2019, 2020, they spent a bit of money on the SAP system. And it's kind of everything that's, directing their 60-60 that's happening in the market. They are the leader in this, and I think what you'll see is they're taking market share. I think that the latest results, they've taken market share from the other players the last 36 consecutive months. So the last 3 years. And think about what's happened. We've gone through COVID, we had lockdown. They were first out. And there were others too, but they did it better. And so if I just think about my household, every week there's a guy coming to drop off groceries. And I know that they're talking about, it's actually cheaper to use it because you have to drive to the store and back, and the petrol you pay. So I think it's innovative. I think they doing well with the private label. So it's just one of those things that I think is bottom drawer that you can bank on even in tough times. And we certainly really happy with that holding in the portfolio. Another one, I thought it'd be good to just speak about a property, because it's obviously also in the portfolio, is Equitas. They, in our view, the premier like logistics, distribution, warehouse type company. Balance sheet's going to be important. Interest rates are going up. Their loan to value is 31%, so nothing to worry about there. If you think about distribution and think about 60/60, you need that space. And what is quite nice, and I try to use these two examples. Equitas has got an agreement with Shoprite, and they have leases of up to 20 years, to run their distribution kind of warehouses for them. And it's a really good synergy, but it just speaks to the demand of that space. And for us, this is, if you're thinking property, we think this is as good as it's going to get in the years ahead. Certainly some defensive qualities there at this point in time. So there's two examples. I don't think you have to worry about them. I think you must understand, and for me, what is quite nice about times like this when it's tough and the portfolio might not look like it's doing as well. You must understand you're buying these quality companies at a lower price. And you're going to get a little bit more in dividends. So we sometimes see these as opportunities to get into higher quality type of portfolios. And just for what it's worth, Shoprite wasn't in our portfolio, not in general, but in 2020 when the markets repriced, it got to a pricing that we felt was appropriate. So you've got to look at these times to even increase your quality more. And I think that's what we'll continue to do in this portfolio.
No, it's lovely to hear these stories about the different companies in the portfolio. I love it. You can buy into those stories. So, Lourens, the purchase of these securities and their income streams should be at appropriate prices, as you mentioned. You buy when the income yield is above the long-term average, making sure you get good value for your investment. And on the back of this, could you speak to us about the fund's positioning? And please touch on the reasons behind the unique weightings between property and equity.
Yeah, and I think buying at appropriate prices is really important. And obviously, with markets coming off, they're becoming better and better. That's really important. You speak about, and we'll talk about it too. You want to buy at when yields are a little bit higher versus what they've been. But what is nice about these companies where you've got these reliable dividends? That dividend yield is actually, it's a meaningful thing because, a lot of people will look at earnings, PE ratios. But, because it's reliable, it pays reliable dividends. You can look at the dividend yield to say whether it's relatively cheap or not. But you have to consider it all, obviously. So absolutely, we do that. And we, obviously, from a positioning within the portfolio, we'll go towards the ones that have held up. They relative to the ones that have come down, you can sell them and reweight to the cheaper ones, but obviously at the cornerstone of this whole thing is quality and improving the portfolio. So you spoke about positioning. I know I mentioned it earlier. So those are the different asset classes, 25% in property, 70-odd% in equities, and then 5% obviously just for liquidity. But what I think is important to understand, we ran the numbers. If you add property, that gives you, looking at where it is at the moment, it's going to give you a little bit less than inflation growth because it's a bit of tougher outlook from an economic perspective. Even equities growth is going to be slower than we'd like it to be. But that combination, we feel, over time, should deliver an inflation-hedged income stream and capital growth over time. So that is the positioning. That's where we've gone. That we think is the highest yield within the quality universe that we're looking at. That'll give you inflation-hedged income streams. So that's the positioning of the portfolio. I've just kind of put it in a pie chart there for you. And after fees, you're looking at just above 4%, but around the 4% mark. And as I said, inflation growth. If you look at the sector diversification, it's very important to know that you're diversified. This portfolio is well diversified. You've got food and beverages at 28%. You got healthcare at 10%. You got property at 25%. You got banking at 14%. Think about the things that everybody uses daily. It's in there. And you know, a lot of people are worried about inflation today. And you know, we look at that and we say to ourselves, well, the only reason how you can get inflation is if Checkers, Spar, Pick n Pay puts up their prices. So stop and think about that for a second. If they put up their prices, there'll be inflation. But at the same time, they sell basic necessities. So hence their earnings will go up by as much as inflation goes up. So you've got a natural hedge here with these companies that you invest here to be inflation hedged, because they actually, their prices going up is what people use to calculate inflation. So it makes absolute sense. And because it's, you know, basic stuff, you know, your sales are going to be very similar. So well diversified from that perspective. And I think it's that really speaks to the positioning of the portfolio. The uniqueness of that asset allocation, as I said, is because that's the highest yield that will give us inflation hedged income.
Given COVID-19 and the difficulties for many companies, can you give us an idea of how consistent the income production has been in the fund, and then what we can expect going forward?
Yeah, I no problem, Ian. I think I've just why I smile a little bit is because, you know, we all, when we sat down together, none of us thought COVID would hit. None of us thought, you know, the economy would be locked down.
I would think that is Amity's bad timing on the fund, launching it.
But I think it's just important to understand this fund was launched somewhere in 2019. But even saying that, you know, this fund has produced a reliable income. And I think it's really important because that's what we're trying to do. Obviously, the start was a little bit difficult. You know, the banks were, you know, told not to pay dividends. Some people, you know, waited to pay their dividends. So, you know, what you're seeing is 2020 and 2021 dividends is like a little bit mixed. You know, somebody didn't pay their interim, but they paid their interim and final, you know, the next year kind of thing.
Yeah.
So saying that, it's been consistent. It was a little bit lower than we would have liked it to have been because of COVID, but it's certainly on the right track. And to give you an example of kind of what's happened is, you know, what I did is I said, well, let's just look at calendar years. If you put R1 million in, you know, the beginning of 2019, or the beginning of 2020, end of 2019, you know, that's the COVID year. You would have got 25,000 Rand, let's say, of income in that year where people kind of withheld. The next year it went up to 27. So you can see it started somewhere. As dividends started to improve, it's been growing. And, you know, obviously more recently we've added some property, so that yield is increasing even more. So for that client that invested, you know, at the end of 2019, you know, he's looking at 35,000 in 2022, and then, you know, 37,000 the year after. So a real bounce in 2022. And I think if you look at the growth from 2022 to 2023, it's around the 5%, which, you know, depending on which calculation of inflation you use, you know, it's kind of there or thereabout. So you know, look for this portfolio to continue to produce reliable income. You know, look for this portfolio if you are using it in a portfolio to reinvest and compound, but if you're drawing to buy back units of the ones you sold. So you know, it's got both those functions in a portfolio.
This strategy of the fund focus on companies that have reliable dividends every year and increasing that dividend. How's this fund different from a high dividend yield strategy?
I think it's a really important point, and I think I touched on it a little bit. You know, we as I said, over the last few years, we've actually looked at high dividend yields as almost red flags. You know, in the past, if we go back, you know, 2004, around there, it didn't matter what you bought because we had a, you know, resource super cycle. Everything did well. It's different now. Times are tougher. Interest rates are going up. Consumers are worried. And you know, quality in the properties that you own, quality in the tenants that you have, quality in the positioning of your portfolio, you know, not having too much debt is really important. And for us, you've got to be worried about a high yield strategy in our view, because what you're getting is a market that is telling you that this thing is cheap relative to last year's dividend. What's really important is what the next 5 years to 10 years dividends are going to look like, or earnings are going to look like. And for us, that's why we're different. We are very much focused, as I said, on sustainable, growing earnings and dividends in the years ahead from quality companies, and that's what we want to hold. And generally, you'll get a little bit less in yield. But when the times are tough, people go to those companies. That's where you get safety. And we really think that that's what you're going to see over the next few years. And truth be told, it's been, if you think, and we can chat about this later as well, is with rates going up across the world, needing to dampen demand to get inflation under control. This is more, in my view, a first world issue. Our demand is not very high in South Africa, but we're going to have to raise rates to kind of protect our currency almost. So we're almost raising rates at like the worst time. We need to be accommodative, but saying that our rates are still low, but it's going to hurt. So I think it's really important to understand that the world is trying to bring prices down, and possibly commodity prices will come down. And this portfolio won't hold any of those resource type stocks, and it's really well positioned for tough times going forward. So in a good place from that point of view.
The fund was launched in 2019, as we mentioned earlier, and has had a rough start with COVID-19 and Russia and Ukraine war affecting markets. Can you touch on the negative returns of the fund, and can investors expect capital growth over the years ahead?
Yeah, so yes, it doesn't look like it. As we started by saying, it's, if you look at, sorry, I'm just going to go to kind of the returns of the portfolio. This is, the blue line is kind of what's happened to your investment if you bought it since inception. It's kind of, you got hit by COVID, you can see there. It's recovered, and then you got hit by the Russia-Ukraine war. So it's been a tough ride. And I think what we're seeing is a lot of risk-off sentiment in the markets. There's this idea that I must just be out of the market at the moment, which you can understand because markets are under pressure. And if you think about those returns I showed you from foreign markets, they're pressing the sell button at the moment. So if you compare that blue line to the red line, which is kind of the all share, what you'll see is that the sector that's done well has been resources. And that, one could argue, has been because we've got supply side issues that has kept up prices higher than they've been. But regardless, it's helped. But the strategy of this fund is to bring certainty and income from quality companies that have the ability to grow their earnings. So resources is very cyclical. So it's excluded from this. So it's understandable why it's done reasonably less than the average, if you look at the all share from that point of view. But we would say, investors, yes, you should expect growth in capital from this portfolio. You should expect a high level of income. And, my longer term outlook for growth is at least inflation. That's what we think. Obviously, because it's been tough, there may be a recovery, but, bank on inflation from a longer term perspective. And to just kind of show you, I showed you the 4 examples. That's the blue bar. If we focus on the income and from companies that grow, we know that red line will follow. So over time, capital growth equals income growth. So yes, it's been a tough road. Bear with this fund because, it can play different roles in a portfolio. As I said, you can put it as that South African equity portion that gives you a high level of income. It can play that role. It can also play, and I think we might get there later, could play a role of a diversifier. If you wanted a general equity fund with resources, but you wanted something else, it could play that role too. So I think there's many functions for this portfolio, and I commend you guys for creating it because I think you can use it, for different aspects.
You've just touched on that because it has a quality bias and must be uncorrelated to many other funds. Is it fair to say that it would be a good fund to combine with others?
Yeah. I'd say definitely, especially if you're that kind of investor that wants different and wants to combine different strategies. Just to kind of simplify that thought, I look at the all share and I think three major kind of sectors. You've got your South African Inc. or quality South African companies, which is kind of where this portfolio is. Then you've got the resources, which is about 40% of the index. And then you've got tech, which is process and Naspers. That's oversimplifying the South African equity market, but that's pretty much it. So in this portfolio, you're going to the left there. That's where we are at. So if you looked at the correlation between the Amity BCI Equity Income Fund and the all share, and I've looked back since its inception, obviously the data doesn't go back as far, and I've looked at weekly prices, how weekly prices have moved, what you'll see is a correlation or an R squared of 0.44. If it was 1, it was perfectly correlated. But what you can see here is, in theory, we don't hold the same stuff, so it's different. But in actual price movement, it's also different. So absolutely, if you're thinking about, I've got a portfolio that's maybe resource heavy, you wanted to dilute that, you could put this portfolio in and you can get a different type of mix for you. So absolutely. The other thing which I think is important, and we've seen this over time, quality companies tend to give you defensive characteristics in tough markets. Now, the drawdowns in 2008 from these type of companies were less. The drawdowns into 2020 on average was a little bit less than your cyclical type companies, which really can come under pressure. So there's a lot of benefits. You get the income, you get downside protection, you get uncorrelated returns, which are all good things when you're constructing a portfolio. And I know a lot of people try and think about these things, but this is certainly a very unique portfolio that can be used for sure.
When marketing this strategy, one is inclined to focus on the income dividends being declared. But how does such a strategy do from a capital growth point of view?
Yeah, I mean, I think, a lot of the South African companies don't have the track records that you can maybe, see from a global perspective. So, we firmly believe that this strategy brings more certainty and outcome, more predictability, less financial anxiety, because, at the end of the day, when markets are tough, you're in stuff is rock solid. So it's going to come back. So you almost want to buy more in those because you're buying quality at discounts, right? Yes. So that's the cornerstone of everything we do. Now, I've shown you an international company here, Johnson & Johnson. I've just kind of highlighted their blue dividend bars throughout different crises, different recessions, which we are likely to go into if you think about all the media headlines that we're seeing now. These are the companies that you want exposure to, companies like you've got in this portfolio, because they'll continue to do what they do. They'll have the ability to increase prices. They are strong enough, big enough to withstand interest rate increases. Their balance sheets are generally very strong, and you'll weather the storm. The only question you've got to ask yourself, in our view, is, can you buy more, in these type of times? So think about that. Speak to your financial advisor, or speak to your client about thinking about opportunities in these times. But if you looked at studies done, from a global perspective about dividend-paying companies, and I know one of the questions that you guys are asking is, well, the fund's not doing so well. Am I going to get some growth long term? And hopefully I've been able to demonstrate there's periods where it can go sideways, it can be under pressure, and we're in that period now. And there's periods where those prices recover to match that income growth from a longer term perspective. So if you looked at studies done from a global perspective, I've just kind of taken this, it's a Ned Davis study, and it really speaks to, I think it's sustainably grow, companies that sustainably grow or initiated dividend have historically done really well. So there's precedent for the strategy to give you capital growth. There's back tested that this does well for you. I think the key is always to be patient, to enjoy those income while it's coming to you. Try, if you're a guy that's drawing an income, try and understand how much income your portfolio is giving you, or what you can get from that portfolio on an annual basis. Try not draw too much from that, more than that. And if you're a young client that's got lots of time to go, you can think about it differently. But if you want to bring more certainty to that outcome, you want to compound that dividend back in, that could be one of the portions in your growth portfolio. It can play that role there as well. So I think it's important to say, thank you. The partnership, I think, is really established. I think we're aligned. And I think, give this fund some time. It's going to surprise on the upside. I really do believe that.
No, that is all time that we have today. And maybe in summary, would you agree that this type of strategy will benefit investors in the following manner? Above average risk-adjusted returns, a more predictable investment outcome, an increase in investment value in line with income growth, reliable income to fund the investor's lifestyle now or to reinvest to fund their lifestyle in the future.
Yeah, Ian, I mean, that's what we're trying to achieve. I really believe if you give the fund time, if you continue to invest in the companies that are, the economy that we live in, that service the things we need, that you're not going to go far off from what you just said. That's what we expect. Obviously, if you've got COVID or a war, it prolongs that kind of a little bit for you. But long term, you're in good stuff here. Long term, you're in stuff that's going to grow. It's sometimes difficult to see that. But we have no doubt that ShopRite's going to be around. Equitas is going to be around. They're going to have more stores. They're going to sell more of their products. And we're going to be there to collect all their dividends and pass them on to our clients.
Lau, thanks very much for your contribution today, and we appreciate our partnership with Marriott Asset Management. If you would like more information on the Amity BCI Equity Income Fund, you are more than welcome to contact our Advisor Experience Manager, Tanya Coetzee. Next up, we have Wiehan Dul, our newest addition to the Amity investment team, that will run through some evidence in favor of an equity income strategy. What we are trying to communicate in this presentation is to put investors at ease by showing backdated data to show how such a strategy works and can provide more conviction in using the Amity BCI Equity Income Fund as a standalone fund with other equity funds, as well as part of an income solution strategy providing income to investors. Look out for the communication in August that will have a video with myself giving an update on the stable income, inflation-protected income, and balanced income solutions.
Morning and welcome everybody. My name is Wiehan Dul, investment analyst at Amity Investment Solutions. Today I'll be presenting evidence in favor of an equity income strategy. The portfolio is categorized by a buy and hold strategy of concentrated, quality, SA-only dividend-paying securities with constant dividend streams. The neutral benchmark exposures are towards financial, industrials, and listed property securities. We hold no exposure to SA resources due to the cyclical nature of dividends and earnings. The objectives of this backtest is to determine whether the strategy provides a reliable stream of dividend income, as well as income that grows in excess of inflation. Next, we'd like to determine whether the strategy provides capital growth in excess of local equities, as well as in excess of the ASISA South Africa Equity General category. Next, does the income stream continue to grow when capital losses are realized? And finally, is the strategy suitable for investors targeting long-term capital and income growth? Our backtesting methodology consists of two phases, under which a representative manager faces a number of constraints. The first constraints are the sector exposures or neutral exposures discussed previously. Next, the security universe from which the manager may select his or her securities. The maximum weight per individual security, which for this backtest we've capped at 7%, as well as the available returns and dividend history within phase 1. Using these constraints and the information available to this representative manager, they construct a portfolio during the period 2000 to 2007. In phase 2, the manager holds the portfolio to determine the capital appreciation and income generation of the strategy. The full investment universe consists of 51 securities. The representative manager then removes any securities in the universe that exhibit non-consistent dividend streams. This leaves him or her with 42 available securities. The quantitative model that the manager uses selects 17 securities that best fit the neutral or market exposures or sectors described in the neutral. Additionally, in order to construct a non-biased backtest, we also need to account for informational biases, given that we already know about many market events post-2007. One of these biases is survivorship bias. Survivorship bias is the tendency to consider the performance of only existing securities in the market while ignoring those securities that went bust. A relevant example is Steinhoff that collapsed in 2017. Given that our representative fictional manager in this exercise didn't know about the collapse of Steinhoff, and given that Steinhoff provided consistent dividend income over the manager's decision period or phase 1, it had to be included. Furthermore, our quantitative model selected Steinhoff as a final holding, meaning that in order to construct a non-biased backtest, we had to leave it in as a constituent. The second bias is a small cap bias. A small cap bias entails knowingly including relatively small cap securities in a backtest that our representative manager knew would provide significantly outsized returns over the holding period. Our quantitative model accounts for a small cap bias by virtue of selecting securities that best fit the neutral exposures mentioned earlier. This therefore automatically selects larger cap securities that explain a greater percentage of the returns experienced by the neutral benchmark. This figure plots the cumulative total return of the backtested strategy versus the relevant sector indices used in the construction of the strategy's neutral benchmark. The dashed line represents the cumulative growth of inflation plus 5% over the holding period. Notice that the strategy outperforms each sector index over time, even after experiencing a significant drawdown in 2017 in the wake of the collapse of Steinhoff. Additionally, the strategy outperforms CPI plus 5 over all periods. Next, we plot the cumulative return to the strategy versus the return of the all-share index as well as the relevant ASISA General Equity Peer Group. The strategy similarly and significantly outperforms both indices over all periods. This relative outperformance of all major relevant indices lends strong support to a dividend-focused strategy on a total return basis. Let's now consider how this strategy performs over 5-year rolling periods versus relevant indices. From this figure, we see that the equity income strategy provided significant outperformance over the neutral sector indices over rolling 5-year horizons, while only marginally underperforming the financial sector and performing in line with the industrial sector since mid-2019. Performance has improved substantially during the bull market of late 2020 and 2021 in the aftermath of the COVID-19 pandemic. Most notably, the equity income strategy significantly outperforms the listed property index over a 5-year rolling period from 2015 to 2020, as indicated by the almost 20% drawdown in the 5-year rolling return realized by the listed property index. In this next figure, we see that the equity income strategy also tends to outperform the JSE's all-share index as well as the ASISA General Equity Peer Group over practically all horizons. Additionally, the strategy has experienced a strong recovery since bottoming in 2020 over a 5-year rolling period. At Amity, our outcomes-based philosophy emphasizes the need to maximize the consistency of achieving a desired outcome over rolling horizons. It is therefore important for us to frequently measure and monitor these outcomes. For the purpose of this backtest, we have chosen to measure the consistency of the strategy's ability to achieve an outcome of inflation plus 5% over 5-year rolling periods. The equity income strategy backtest was able to achieve an outcome of CPI plus 5 69% of the time since inception in 2007. In comparison, the industrial sector achieved this outcome 61% of the time, while the financial sector, listed property sector, and all-share index only managed to achieve this outcome 58, 53, and 52% of the time, respectively. Finally, the relevant peer group, the ASISA General Equity category, produced a meager consistency measure of only 30%, lending support to the long-term consistency of an equity income strategy. In this next figure, I'd like to highlight the relationship between price and dividend growth over the holding period. Price is represented by the red line and is plotted on the left axis, while dividends, as measured by the weighted cents per unit, is plotted on the right axis. During periods of stagnant or negative price growth, dividends, in most cases, remain constant or continue to grow. Relevant examples are the global financial crisis of 2007 to 2008, as well as the crash in Steinhoff that occurred in 2017. While dividends fell significantly in 2020, This was due, as we all know, to the effects of the COVID-19 pandemic, and specifically due to firms holding back on dividend payments to strengthen their balance sheets in the face of significant global uncertainty. In 2021, as markets recovered and uncertainty reduced, dividend payments continued, and the long-term income stream generated by this strategy remained robust, even though the capital value of the strategy had yet to fully recover. We expect the resilience of these income streams to continue in the face of current market volatility and towards the end of 2022. Here we see the actual income generated from an initial investment of 100,000 Rand over the holding period. The yearly income received increased from 1,300 Rand in 2007 to 4,000 Rand in 2021, while the total income received over the period amounts to over 40,000 Rand, or 40% of the initial investment. Additionally, we see that the annualized increase in dividend income amounted to 8.28% per annum, despite the volatility experienced in 2020. Finally, let's consider the cumulative increase in income generated over the period compared to the growth in inflation. From this figure, we see that income growth has significantly outpaced inflation in every year since inception of the backtested strategy, including 2020. The cumulative growth in income amounts to 380%, while the cumulative growth in consumer prices was approximately 235%, providing a real cumulative income return of 152% over the period. Finally, to end off, we've shown that the strategy provides a reliable stream of dividend income, as well as income that grows in excess of inflation. Additionally, we've shown that the strategy provided capital growth in excess of local equities, as well as the relevant ASISA South Africa Equity General category. We've shown that income streams continue to grow when capital losses are realized. And finally, that this strategy is suitable for investors targeting long-term capital and income growth. Thank you to everyone for joining us today. If you have any queries regarding our financial solutions, please feel free to contact Wiehan Dul, our Advisor Experience Manager.
Thank you, ladies and gentlemen, for attending our monthly webinar. As always, we will circulate the presentation and a copy of the recording. Remember, we also post the recordings to our website. If you have any questions on the fund and topic discussed today, you are welcome to contact Wiehan Coetzee. We'd like to thank Marriott Investment Managers for participating in this month's webinar. Please join us again in August for a feedback session on our outcomes-based investment range.